All right, so welcome back. Today we're taking a look at the markets. Right now we had the Fed president, James Bullard, there said rate hikes had only limited effects on inflation in one of his chats. And, so the market is pushing lower from some of these comments. And of course, it makes sense based on when you start looking at just how slow things move anyway. I mean, the Fed overall moves slow to try to tame inflation. They waited so long, and now they're expecting a quick return or result. Of course, it's not going to happen. Things in just government and policies, they always move slow. It's a trickle down effect. Anytime you have kind of a $1 spent, let's say you buy a burger at McDonald's, then that $1 earned goes and moves to the employee. That employee buys maybe new shoes. Those shoes, or that shoe company then takes that money, pays their employees, and so on and so forth. So it takes some time for everything to kind of trickle down through the economy and through the systems. It's not going to happen immediately. So for inflation to come down that quick is just not realistic and not really feasible or possible to think about it that way. So anyways, these comments, they push the market down. We were basically sliding on a hawkish Fed comments because, they're saying they're going to have to raise more and more and more just due to inflation. Well, I mean, they've been printing money now for so long. So if you look at just the amount of money printed over the last little bit, we would have been better off not printing that money and been just kind of living off of soup and cans for a much longer time period there. And now we're worse off, right? So if you kind of look at the housing prices in the past, you just kind of look at what was going on. Let's say you were looking at a house that was $800,000, okay, 2 years before the coronavirus. Then that house got into a $1 million range. And now some of those houses are back, let's say at 820,000, but the problem is now you've got a bigger mortgage or interest rate. So let's say you're paying, I don't know, let's just say $5,000 a month, depending on the loan. But let's say it's about a $5,000 a month premium before. Now for that same house, maybe $20,000 more or higher, you're paying now $7,000 a month because you have to go ahead and pay the interest on it. So you're actually at the end of the day, instead of paying $800,000, which later on with interest, you might pay like $1.3 million for the home. Now this 820 that you got to pay, you might pay like 1.65 million for that home at the end of the day. Again, my numbers there are just roughly estimating or just guessing on there, but I'm just showing you the concept of what's really going on. We would have been better off just kind of leaving things as were. Than we would have printing all that money earlier on. Anyway, that's besides the point. That movement is done. So there's some talks and discussions here that he made. And when you start looking at it, with the investors, that they're kind of worried about further push for interest rates. That kind of pushes the market lower because now you've got, hey, we got to raise more. We thought we would be good. CPI and inflation's going down. We thought we were kind of good. And basically he said even a dovish policy would require further rate increases because he's basically saying that, just didn't do squat to the inflation. So he said, arguing rate hikes are so far have had very limited effect on observed inflation. And of course, number one, it takes a lot of time for it to happen, to go through the system. Just like if I'm trying to lose weight or gain weight, it may take multiple months. It's not going to happen in just overnight. So that's kind of the issue right there. So you can't really think about it that way. Anyway, so as you start looking at just what's going on here with the inflation numbers, if we look at here, this macrotrends.net, and we look at the United States inflation rate on the CPI here, this is just the inflation rate from 1960 to 22. You can see how inflation's picking up speed. I mean, it's not as bad as the 70s and the 80s here really skyrocketed. So we are kind of pressing here on this upper end and range, and we're starting to really pick up speed. So they're trying to do something, but usually, just like if a car is moving 65 miles an hour, it takes time for it to stop. It doesn't just stop right there. Just because you decided to raise very quickly, very fast, it still takes time. It's still going to follow through. And just because I decided to push on the brake immediately really hard, my car is still going to be flying for a while. So I need to have enough runway. So they didn't do that early enough. And that's a bit of the issue. So just looking at the overall historical data, this is a bit of the issue and problem. So Anyway, looking at overall the markets right now, these markets are not doing so well. We're pulling back. If we take a look at just overall here, let's take a look at, what am I typing here? Okay, so if we just take a look at the overall markets right here, like Lowe's, we're pulling back. Here's Apple. Take a look. We're pulling back. Certain stocks are pulling back more than others. You've got stuff like Etsy. Here, we'll go on the daily. So you can kind of see Google here. I think there's a few spotlights where stuff like Google's doing okay, but if you look at stuff like Netflix here, we're down pretty big because we just had a bigger run. Caterpillar also down. I traded this one short, and then also Goldman Sachs. When you start taking a look at this one here, we were up pretty high, then we're pulling back a little bit. So again, certain companies are pulling back quite heavy, and it doesn't look very good right now for today. But again, if you just look at the SPY, just where we were kind of moving up right here from October 12th. We've been kind of trending higher. Now we're doing a little pullback. So it's to be expected that we might have this slight little pullback. And even then the volume just here at the bottom area, you can see on this little pullback is weaker. It's okay. And the bullish volume was a little bit stronger. So for now, it's okay. It's one day. But if this continues to accelerate, that could be a little bit of a problem. And you could come back to retest some of the lows here at those levels. So we'll see what happens from there. But ultimately, the Fed speak here, got them a little worried. But I mean, but the market just reacts very quickly just to all the different words that people state. It's not as logical or rational thinking. A lot of it is, oh my goodness, we're gonna have to hike further or more. Yeah, absolutely. I mean, and inflation, is it really going to come down much? I don't know. What I think will happen is more we will stabilize, right? So instead of going up like this, and let's say food prices, let's say a tomato, let's just call a tomato $3. So then it was like $4, then it'll be $5 and $6. Well, instead of kind of going up like this, what we might end up doing is kind of going, okay, slowing this down where the price of it is then more flatline. So rather than going at an accelerated curve, we'll flatline it. So instead of $3, then you get to $4, then it'll be like $4.10, then $4.15, $4.25. And that's what's going to happen through time, much more so. And that's what they're trying to do. But will they go, from a $4 move back down to a $2.98, or will bread go from, a $5 loaf back to like a 98 cents loaf that I saw back when I moved to the U.S.? Probably not. I don't think it's going to happen. But that's what they're trying to do, is just slow down the pace of the increase. But I think the increases as far as prices here, will they come back? Maybe they'll come in a little bit, but not anything major. At least that's my idea or perspective. I could be wrong depending on how crazy things get. But I don't think they'll, they're not going to get cut in half is what I'm saying. Because you're not going to see, I don't think, let's say a $40,000 car go down to $20,000 in prices. I just don't see it. Right. So what are they looking for? A $40,000 car, instead of being $50,000 next year, maybe it'll be like $41,000. That's what they're looking for. Or a $40,000 car, maybe drop to $37,000, maybe. But even then, that's a small, tiny bump down. It's not going to be that huge. Right. So anyway, this is just my perspective and thought, and hopefully that gives you some idea overall of just what I think is going on and happening. Thanks for joining me. Truly appreciate it. Feel free to grab some freebies here on our website, criticalcharts.com or tradersfly.com if you're trading options. Definitely a lot to learn on the Tradersfly site for option traders as well. All right, thanks again, and I will see you next time.